Well, I mean, the mere fact of record highs shouldn't be a problem. The economy and most corporate profits do better over time, so most things should gain over time. I think that on the one hand, the economy and the bull market are old, but on the other hand, the economy still appears to progress, and the valuation of the stock market is not egregious.
But it is at levels, I guess, that led to pullbacks late last year and early last year.
Well, that's right. You know, look, the market can do anything, anytime, and it certainly did so in the fourth quarter. I thought the fourth quarter move was overdone and unwarranted, and it snapped back.
When you say not egregious valuations, what do you mean?
Well, you know, the long-term history of the PE ratio on the S&P is 15 or 16. It got up to 18, which is a little high. It got down to 14, which is a little low. Now it's barely on the high side, but I mean, you know, you look at 2000, the PE ratio is 32. That's egregious. 16 or 17 is not egregious.
When you look out there at the moment and you try and work out how much risk to be taking, what are the key factors that you look at?
Well, there's so much to look at. You know, there's the length of the recovery and bull market, how far they've moved, the valuation levels, the economic outlook, the geopolitical factors, and then there's psychology. What kind of psychology is factored into prices? You know, the relationship of price to fundamentals is determined by psychology. When psychology is too euphoric and too bullish, then the price will be too high relative to the fundamentals, and vice versa. So we want to know how much euphoria is incorporated in security prices.
So what does all that thinking tell us about where we are today?
Well, today we're a little on the high side. I don't see a lot of euphoria. I don't see people saying, you know, this is your last best chance to get in the stock market because it's going to the moon. The market has been doing something that when I was starting in this business, we used to call climbing a wall of worry. You know, people say, oh, I know it can't go on forever. What could stop it? That's healthy if people are cautious in their expectations. So I don't think that the psychology is nuts. And it hasn't been really throughout the whole bull market. What's a little challenging is that it's all caused by low interest rates, because the ultra low interest rates cause people to desert cash, treasuries, and money market and high grades and move out the risk curve in pursuit of what they consider acceptable returns.
This is something you've been warning about for a long time.
And I'm not going to stop.
You still see a credit bubble developing?
Well, I see, because of the low returns on safe instruments, I see competition to get into aggressive instruments. And when people compete to put money out, they do so by being willing to receive low prospective returns and high risks. And if that's the case, we should know about it and act accordingly.
But